Okay, good evening and welcome to Tribe Tuesday. Let me just pull out my slides and really welcome all of you guys. Next Level Tribe. Right. So in Next Level Tribe, in case for those who are new, every single Tuesday, that's where we'll go through Investing University. And Investing University, we'll talk about the fundamentals, technicals, options, and even quant investing. This will be very suitable for any of you guys who are very new to investing, or even if you are seasoned to investing, but let's say you are very skewed into like fundamentals and you want to learn about technicals, that's where we will touch upon it. So quick disclaimer, I'm not a financial advisor, I'm not licensed in any way, so it's not a recommendation to buy or sell. By the way, if you guys can hear me and you are new for the first time, you can type 0. If you have been like following Tribe Tuesday, you have been watching Investing University, you can type 1. Okay, so do also remember to watch the rest of the previous videos. We have a series of videos that talks about various ways of investing, and we have been talking about fundamentals, breaking down into income statement, balance sheet, cash flow statement. We talk about valuation methods, and we have been talking about technical analysis. So today we'll be talking about technical analysis part 2, and I'll be talking about indicators. Okay, thanks a lot, Clara, Jason. Thanks, at least I know that you guys are hearing me. So today this is the key overview, but mainly speaking, right, I want to let's say go through a few things with you guys. So the first key thing I want to share with you guys is this thing called multi-time frame analysis. It's one of the important things of technical analysis. And last week, in case you have not watched, please watch the video last week. It's on the playlist. We have talked about uptrends and downtrends. Now, can I ask you guys this question? This is a particular chart. Can you all share with me, based on your observation and what you think, is this an opportunity? If it's an opportunity, also let me know whether is it an opportunity to long or short. If you think it's long, help me type L. If it's short, help me type S. Okay, so as I wait for the answers to come in, your response to come in, this is what we do. This is what we typically call a downtrend, where we link the top, all the highs, we call it the highs and the lows. The highs is the top point. Okay, let me just use an illustration for this portion. This is what we call a high, and this is what we call a low. We will aim to link all the lows together and all the highs together and all the highs. You can see that there's a certain gap. It's not like perfect. And right now it's a high as well. So is it a long or is it a short opportunity? So some say long, some say short. Okay, so typically I was trying to induce you guys to think that it is a shorting opportunity. Okay, the price may go down. Now, however, if you notice, let me change the color of the pen. If you notice, this is a 1 hour time frame. Meaning to say, if you remember, based on last week's lesson, every single bar you are seeing here is a 1 hour time frame. So if we zoom in, this is maybe like from 4th of March all the way to 18th of March. It's probably like 2 weeks. Okay, around 2 weeks. Yeah, around there. But if we zoom out, okay, if we zoom out, you realize it is here. This is what we have been seeing just now. But if we look at it from a daily candle perspective, right, over the past 1 year plus, it has been on an uptrend. So now this is why we say that it's very important to look at multi-time frame analysis. So whatever that we are actually like aiming to like buy or sell, using technical analysis will give us a view of whether it's going uptrend or downtrend. But don't look at it from only one time frame, because sometimes if it looks like a downtrend, but the overall, the bigger trend is actually uptrend, you do not want to short the market. This is a general perspective. Obviously, if you got your specific ways of like analyzing things, go ahead, use your own method. Okay, so it's very important. Can you all please help me type MFT, multiple, oh wait, is it MFT? Hang on, what's the key thing again? Okay, please help me type MTFA. Okay, multi-time frame analysis is very, very important. So let me just give you guys some more examples, but right now may not have that much examples because the stock market has been going uptrend pretty much. By the way, where do we analyze all this? Using your IBKR, you can actually go into like specific stocks. Let me go into, let's say, coin as in Coinbase. So this is a very interesting stock. Again, not a recommendation to buy or sell. It's an interesting stock because it is very volatile. Its pricing is almost like similar. The price movement is almost similar to Bitcoin. Let me just clear away all this. So this is what the stock price looks like. So you can see that right now, what we are seeing is a day candle. And this is over, let's say, 1 year. If I look at it over 1 year, it looks like a side range, correct? Okay, so this is a side range, or rather we call it ranging. Now, if it's a ranging market, okay, obviously there are various methods of entering a ranging market, but these are some of the support and resistance. Now, if we know there's a ranging market, right, looking at, let's say, the daily candles, okay, and let's look at the weekly candles. Okay, weekly candles, let me change this to week, 1 week. We may see a different perspective. So if you look at a weekly candle, and this is it 5 years? Or, okay, typically, interestingly, you will see that for the Coinbase, it has gone down, it has gone up. Again, it is ranging. So when both time frames, right, they matches each other's range or trend, it is a confirmation. However, if you can see this example here, if you see the big picture, it is ranging. However, if you zoom in here, it will look like a downtrend. Let's go for it. You see this particular smaller portion, it will look like a downtrend. Oops, it's a little bit hanging. Okay, it will look a lot more, much more like a downtrend. And they are trending down in boxes. Okay. Okay, so you can see a break that. If you all remember the lesson from last week, okay, when they break a particular support, it becomes a resistance. And they break another support, it becomes a resistance. So there's different levels, remember? So it seems like it's going down, down, and down. So for a particular like trader who is looking at this, they say, wow, it's going downtrend. So the next time it breaks a support, I may want to short the market. However, when you look at it from a bigger perspective, okay, from a longer time frame, now it's actually a major support here. Okay, so it's a very, very big range. Using a particular bigger range, right, will give you even stronger support and resistance, because you do not want to sort of mess around with, or like you want to actually understand that if let's say this is a very strong support, well, even if it goes break a little bit, it may actually retrace back. So it gives a lot more information. So I would love you guys to actually take a look at this. And this is the particular, okay, let me just switch my screen again. So this is the particular, I would say, mantra that a lot of investors who use multi-time frame, they use. So this is the key idea. Let me show you guys this. So use the rule of 4 to 6. So if let's say you're doing swing trading, meaning to say you do not buy and sell on a daily basis. You buy and sell within a weeks. You want to start by looking at a monthly time frame, followed by a weekly, then finally a daily, to see whether is it a best entry or exit. So let me give you an example. Okay, so an example, if you have examples that you want to actually take a look at, you can let me know as well, so we can use it as a case study. So an example that I noticed recently is this. Yeah, actually I was looking at 𝗲𝗂. I thought 𝗲𝗂, later I show you why I think 𝗲𝗂 is pretty interesting. So for me, I'm not really a day trader. I usually buy and hold for weeks or even months, sometimes years. But recently, because I use more of options, I don't really hold for years because the options may expire. So I will exit using trailing stop loss, which I will touch on probably later in the lessons, as in the next few lessons. Okay, not this lesson. So you can see for 𝗲𝗂, what do you all think? Okay, if we look at just the daily time frame, okay, it looks like an uptrend. So what is useful for us, right, is we want to look at the weekly or even monthly. So let me change this to weekly. Okay, so if I look at weekly, right, at least it is not a downtrend. One thing that we want to make sure is we don't want to long a market, like I'm going to buy it based on daily candle when the whole entire market is down. So it seems to like even support the idea that 𝗲𝗂 overall is still a uptrend stock. Okay, so this is a weekly. Let's take a look at monthly. Oh, if you took a look at monthly, this is maybe they don't have enough data for us. Okay, this may not be the best idea. Let me show you guys another screen using trading view instead. So trading view, why am I using the IBKR instead of trading view? is because 𝗲𝗶𝗂𝗃𝗲, they allow us to put multiple indicators. So this is 𝗲𝗃. Again, this is the daily time frame. Okay. This is day. Then I can go to weeks. Okay, it's still uptrend. Is it obvious there's uptrend? If it is, you can put U for uptrend. And finally, monthly. So you can see that 𝗲𝗃 is, no matter which time frame you look at it, it is a uptrend stock. Now this gives you a lot more confirmation and also a confidence in this particular stocks, correct? So you obviously there are some stocks that is turned around. Sometimes they go all the way, they go down for a while and then they bounce back up. So example, if you have been like in this particular area in 2020, you will see a very big drop. And this big drop, right, will be seen in terms of daily. Let me show you this. Oops. So let's go back to 2020 during COVID. So this 2022 or even 2022, you can see that it looks like it is going sideways. Not so much of a downtrend. Oh, but here, if let's say you are caught in the portion of this, you may be tempted. If let's say you are someone who short the market, you may be tempted to short even 𝗲𝗃, okay? Because this is a day candle. So, oh, it's maybe a good time to short 𝗲𝗃. Now, does it mean that you will lose money shorting 𝗲𝗃? Depends on when you are going in. But you can see that this is a daily candle. If you're going to change it to weekly and monthly, right, it will not be a good idea, right? Where's the 2020? Here, you will see that this is the place that I draw. It's not a good idea to short 𝗲𝗃 because the overall trend, it is still pretty much bullish, okay? If you draw it for long. Like here, this is the part you say, oh, you want to short 𝗲𝗃, but are you sure you want to short 𝗲𝗃 when you look at the weekly candle? So it's very important to use multiple time frame analysis. Now, is this valuable so far? If it's valuable, you can type V. This is something very important, and a lot of people tend to overlook this portion. So it's very important to look at the multi-time frame. Okay, so now this is the first big portion when you use technical analysis and when you use start to actually add in indicators, because you have to look at the big time frame. So even technical technicians, right, they put in a lot of hard work to analyze. Now, of course, if you're a day trader, if you're going to enter based on 15 minutes candle, whichever candle time frame you're going to use to enter, multiply it. Okay, aim to multiply it by about 4 times to 6 times. So from 15 minutes, look at 1 hour, look at 4 hours. If you're going to enter the 1 minute candle, you're scalper, you go in and out very, very quickly. Again, do not trade against the trend. So make sure that the biggest trend, the mid trend, and your current trend, right, is a similar kind of trend before you decide to enter. Okay, so this is the important portion. So this is a multi-time frame analysis. Okay, the next portion, homework for you guys to do. Okay, so okay, haven't finished. So again, these are some key points. Higher time frame always dominate lower time frame. Make sure you always look at the higher time frame first. Then you can confirm with support, resistance, and the trend across time frame. If there's a lot of confluence, the big time frame, middle time frame, and your current time frame is all similar, it gives you a lot more confidence. There's no guarantee, but a lot more confidence, because you must know that different players look at different time frame. Typically, big institutions, they look at the big time frame. So if let's say the big time frame is an uptrend right now, if the big time frame is an uptrend right now, and it's hitting a support, there's a high chance that if let's say a lot of big institutions that looks at, let's say, weekly time frame or monthly time frame, and they want to enter here, you may not want to go short. Okay, because you may look like, wow, it's going to break down. You look at the daily chart, it looks like it's going to break down. You don't do that. Always look at the bigger time frame. Okay, so also avoid overcomplication. Stick to maximum 3 time frame. Sometimes you can look at even 2 time frame, that's enough. Okay, don't go for more than 3. Okay, so this is talking about time frame. Let me move on to the next portion about indicators. So in charting, most of the traders use indicators to guide their entry and exits. And there are 2 big general categories of indicators: leading and lagging indicators. Now, as the name suggests, leading indicators are predictive indicators. So they are predicting, they are signaling potential trend reversal before it occurs. So you see, well, probably they're going to hit a particular support. They're going to hit a particular resistance. And there are certain indicators that are predictive. They help us anticipate price movement. But of course, again, all indicators can be wrong sometimes. In fact, maybe half the times or even 60% of the time. So all these will help us in our analysis, but they are not, I would say, guaranteed. Now, there are lagging indicators, and these indicators are called confirmation indicators. So typically, they will tell you what the trend is after they already started. So the reason why sometimes you need confirmation indicators is because just based on the price movement alone, right? You may not be able to see, is it uptrend, is it downtrend? It looks like sideways. So these indicators make it more scientific to tell you, yes, it is correct, it is confirmed uptrend or it's confirmed downtrend. So they help traders avoid false breakouts, okay? So now, let me give you some examples. Let me go to lagging indicators first. Now, you can see a whole list here. And if you have not joined us in our Telegram group, please join us. I'll be putting all the slides in there. Our new guys to do homework and go and find indicators that speaks to you. Now, most of the traders, after a while, if you've attended courses before, if you've attended talks by some technical traders who are very successful, they will eventually choose a few of them to become their weapon. They will choose a few indicators to mesh it into their ultimate way of entry and exit. So it is time for you to create your own. So do look through all this and see which one is more suitable. Now, when I talk about which one is more suitable, it also depends on what you are trading. Example, maybe Parabolic SAR works better on Bitcoins, and maybe let's say ADX works better on forex kind of pairs trading. Okay, so depending on what you are trading, you should use different indicators to check it out and see which one is more suitable. Because it typically, not all indicators can cover all the asset classes. And usually indicator works, right, is because that particular asset movement, example, let's say we talk about forex, we talk about USD, Japan yen, USD pair, correct? They have a particular set of players or people who are trading it, and they have been used to using certain indicators. So certain indicators will be a lot more, I would say, self-fulfilling prophecy. So this is the whole key idea. So again, these are lagging indicators. Let me go through some with you guys. Moving averages is one of the most common, and therefore, because it is common, it is usually a lot more effective. So depends on your school of thought. But I'm also, based on my years of experience, I realized sometimes there will be certain unique indicators that will give you a little bit of advantage over other traders. But most of the time, the common ones will be the one, since everybody is using it, the movement will be more predictable. Okay, so again, moving average is basically commonly used in technical analysis, used to smooth out price data. So how does it work? So the popular moving averages is 20 days moving average, 50 days, and 200 days. For those who are very familiar with this, so please bear with me. We'll talk about the rest in a moment's time. So let me show you how it works. So moving average, if we go and take a look at, again, 𝗵𝗂𝗶𝗃𝗲, let's take a look at, okay, let's take a look at 𝗵𝗂𝗃𝗲. Okay, 𝗵𝗂𝗃𝗲, by the way, it is a stock itself. So let me zoom in a little bit. So this is the price movement. Now, is this uptrend? Is this downtrend? Sometimes it's very hard to tell. So what do? We use this thing called moving average. You can go to indicators, okay, and you can type moving average. So you can type moving average here, and by default, I think this TradingView, by default, TradingView use a 9-day moving average. What does a 9-day moving average means? It means that if you see this particular line, right, the latest line here, why is there you can see the latest line here, the 9-day moving average is 174.29. This number is derived by taking the closing price of the past 9 days, adding together and then dividing it. So it's average. It's a moving average. Okay, average of 9 days. So what we can do is, using these 3 dots, we can go to the settings. We can change it to 20 days. Okay. So when you change to 20 days, you see that the number changes. Okay, so it is 193. Okay, instead of 17 something. So you can see that it's further away from the line, but it tells you for the past 20 days, it has been going on a downtrend. Now, again, moving average is beautiful because we can add various moving average and it tells us multiple time frames. Okay, what do I mean by that? So this is 20 days moving average, and as I mentioned, the popular ones are 20, 50, and 200. Again, dependent on the particular asset we are using. So let me add a few more indicators. Moving average. You can add multiple moving average, or you can just add a moving average double. Moving average double means you can change. Okay, the first period, you can put 50 and then 200. So now we have 3 moving averages. The 21 is the most sensitive. It swings up and down the most because it's a 20 days moving average. 50 days is adding 50 days together and averaging out, and 200 days is here. So now, if you look at the multiple time frames, right, you can see it is or rather the multiple moving average. It is like what we mentioned just now. The 20 days moving average is now on the downtrend. How do I know it's a downtrend? Now, the way that we look at whether it's an up or downtrend, typically we look at whether the price, which means the candlestick of this particular asset, is it above or below the moving average? So let me just hide this. Okay, let me hide this. So if it's on a 20 days moving average, so based on a 20-day movement, right here, when it's above, you see the candlesticks, is above the line, is considered uptrend. And when it cuts below the line, it's considered change in trend. It can be a side trend because it's cutting sideways, and now it's above again, it's considered uptrend. So you can see that the moving average is a confirmation. It tells you, yes, it is uptrend. Yes, it is side trend. Yes, it is downtrend now, because now it cuts down below the moving average. Initially here, even the moving average will look relatively flat, but now it's turning down, so it's a downtrend. However, if we use 20 days moving average, say, oh, it's a downtrend, we should short the market. Nope, we should look at 50 days and 200 days, because as mentioned, this moving average is a practice of multiple time frame analysis. So 50 days is also a downtrend, but the bigger trend, 200 days, is the bigger trend, because 200 trading days is almost near about 1 year, about 10 months of data. So the price is still above the 200-day moving average. So the bigger trend is still an uptrend. Can you see that? Okay, this is the bigger trend. And how do people use moving average? Typically, if the price is above the 200 days moving average, it is generally considered an uptrend. You can see right here. Let me just change the color of 20 days so that's easier. Let me change it to green. Okay, so you can see that the blue color line is the 200 days. 200 days. Let me make it slightly thicker. Okay, so 200 days is the thick one. Now it has gone below, right? It is not a good time to buy the share because it may not be an uptrend. It may be sideways trends or even a downtrend. When it cuts above the 200 days moving average, is considered uptrend again. And typically for traders, what they want to see is the price. Okay, this particular stock price, it is above 20 days, 50 days, and 200 days. It is like a confirmation that yes, short term, mid-term, and long-term is an uptrend. So this may be a good time to buy, let's say here, when it cuts above 200 days, above 20 days, above 50 days. And another indication that typically traders like to do is, now you can see that the green color line is the 20 days moving average. When 20 days cut below 50 days, okay, when 20 days cut below 50 days, maybe you want to take profit. So you have entered, let's say somewhere around here, okay, entered here, as we mentioned, maybe let's say here. So when do you exit? So using moving average crossover is a good idea on when to exit. So right here, you can see that, wow, 20 days is nicely above 50 days and 200 days is nicely, it's still uptrend, uptrend, uptrend. But now 20 days is merging, crossing below 50 days. Okay, let's get off here. Okay, and it starts to drop, right? It starts to drop. And when do we enter again? So you can see the price going up above 20, above 50. But right here, can you see that the green, again, the green color line, just to remind you guys, the green color line is the 20 days SMA, simple moving average. This is the green color line. Whereas the orange color line is the 50 days SMA, simple moving average. We can use simple moving average, we can use exponential moving average. I'm not going into details of that. Do your study, it's very interesting, okay? So typically, another point of entry is when the 20 days again cut above here. Cuts above the 50 days. Right here. A smiley face. Oops, this face a little bit big. Here. Can you see? Here it cuts above. Now, let me share with you. On this on high side. But when you're doing actual trading, right, it takes some time before the line is confirmed crossed over. So let's say around here. Okay, crossover. So 20 days has crossed 50 days and is nicely above 200 days. Okay, some traders may even wait until here to confirm again. Okay, but once it crosses over, it may be a good time to enter again. So once you enter, let's see. If we enter here, we write the price all the way up, 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 up. When do we exit? Maybe somewhere here, you may consider exiting because the 20 days is merging with the 50 days. I can tell you on high side, okay, we know that it's just touching. It did not exit yet, but you may choose to exit here. So there's a 44% in 126 days. You may write it even further and you may exit here when you cross over here. So here, you enter here, you may exit right here when the 20 days cross below the 50 days. So I'm going to give it a few days because again, when you're actually trading, you will not be able to see. So if you cross over here, it's actually down here already. Oops. So it's 34%. Still not bad, but here would have been a better time because you save time on this. So this is how traders use moving averages. It's one of the most powerful. They call it the golden cross. Okay. So again, I hope this has been clear. Okay, if this is clear, this is useful. Help me type MA for moving averages. So remember 20, 50, 200. But based on the instrument you are using, do go and check and see. Maybe some instruments, they work better on 180 days instead of 200 days. So have a short term, mid term, and long term. All right, let me go to the next portion. Moving averages is a lagging indicator. And this lagging indicator will tell you trend. Okay, so as mentioned about this. Okay, so moving averages, one of the most, my own personal favorite. Okay, I do use moving average a lot. And I use 200 days moving average because for me, I do not do a lot of short-term trading. When it goes down, I do a lot of shorter term using options, but not enter and exit into stocks that quickly. Okay, I use moving averages and I use trailing stop losses. Okay, another lagging indicator. You can see there's a lot. And all this is not exhaustive. There's even more. I'm just putting a few here. You can actually look at another one called Parabolic SAR. So Parabolic SAR, it attempts to give traders an edge by highlighting, again, the trend. Is it uptrend? Is it downtrend? And why is it called SAR? It's called stop and reverse. Means that trend is going to reverse. Trend is going to change. So it's a very clear indicator. This one is very, very cool. So let me show you how does Parabolic SAR looks like. Let me go to the charts again. So for Parabolic SAR, okay, let's go to IBKR again. I'm going to clear away all the moving averages. And let's focus on Parabolic SAR. Later we can try other charts as well. Okay. So there's this indicator here. Click on here. Type Parabolic SAR. You can see here. Now Parabolic SAR, you can see all the dotted lines. Let me make it a little bit more obvious. Make it thicker. Oops, also thick. Okay. You can see here. So very simply put, when the price is, okay, or rather the dotted line is below the price, it means there's an uptrend. So you can see right here. Let me zoom in. Like say this portion. When the dotted line is below, it means there's an uptrend. So you can buy and then hold it and then you sell here. Because now the dots is above. When it's above the price, I mean the candlesticks, okay? So when it's above the candlesticks, it means that there's a change in trend. Okay, there's a stop and reverse. So example, if we have bought in, based on Parabolic SAR, it will look like this. If you are using this as a exit and, okay, you could have bought in here. Because this will be very obvious. It will show that day, okay, it has changed in trend. So you have bought here, and you have sold, let's say, here, change in trend. Okay, so it will be somewhere from here, somewhere around here, to let's say here. About 9%, okay, in 26 days. Well, this is again an estimate because sometimes you do not know where you are buying it. Is it on top of the candle, below the candle? But it's a change in trend. Okay, so about 8%, 9%, 7% in 26 days. Okay, another example. Let's say it's going down, and here is a good time to, let's say, enter. When you're doing back testing on this, right, visually, you may want to take 1 or 2 days later. Okay, maybe not the exact dot. The exact dot is too perfect. Because remember, when the candle is bouncing, right, this particular Parabolic SAR dot may appear on top, below, appear on top, below, until the candle finish forming. it takes maybe 1 day to finish forming. Okay, I hope this makes sense to you guys. Really realistic way of looking at it. So this is the place that you may possibly enter, okay, which is 1 day later, okay, and this is the place you may possibly exit. Let's say here again, 1 day later here. I'm going to put here so that you can see is from here, this small little candle to here. So if let's say based on Parabolic SAR, click from here all the way to, let's say here at the bottom, 14%. Now let's try other stocks. Maybe 𝗵𝗂𝗲𝗃 is really quite perfect in a sense. So let's talk about other stocks. I'm just going to use some of the list here, okay? Let's say US Steel. I've not seen this chart before. Let's see what it offers. Okay, wow, this one is a lot more. You can see that there's no clear trend, right? So this one, wow, a lot more, I would say, sideways moving. So for Parabolic SAR, for US Steel, okay, for a sideways, let me zoom in a little bit more. Okay, wow, it fluctuates a lot, man, this one. So let's say here, I'm going to enter, let's say here. You can see, change in trend. And then let me exit, let's say here. Okay. So it will be from here to, let's say here. Okay, this one you can see sideways. When it's sideways, it doesn't work very well. Do you realize that? Because Parabolic SAR is a trending indicator. So when this particular, I would say, stocks is sideways, Parabolic SAR doesn't work very well. It works with trending stocks like 𝗵𝗂𝗃𝗲 moving average. So let us do one more thing. We're going to add in the moving average. Okay. Moving average. Let me go for the moving average double. Okay, looks a little bit cluttered already, right? So later I'll have certain rules for you guys on how to make sure it's not too cluttered. So moving average settings. Let's go for the 50 days and 200 days. Now, can you see even for the 50 days and 200 days, there's no clear trend. There was a clear trend here. When the price is moving up, there is a clear trend here. So when the trend is clearer here, Parabolic SAR may work a little bit better. Well, okay, here, swing all the way up, and then get, this one is like a perfect scenario, right? Because there's a gap. It doesn't always happen this way, okay? But right here, the place that we were starting, it's so cluttered. The 50 days cut below the 200, and the price is dancing along this full moving average. It becomes a sideways trend. So not a good idea to use it for, let's say, entry and exit very quickly using Parabolic SAR. So what it means is this. Later you will see that a trader will combine a few indicators together. So example, combining moving average for trend confirmation plus Parabolic SAR for a double trend confirmation and entry and exit. Because Parabolic SAR also gives very clear entry and exit. Okay, is this good? Okay, if this is good, can you help me type 2x? 2x means you can combine two indicators to form a particular better entry and exit. So let's see. Another trending stock. Let's go for another trending stock. It'll be a lot easier to see it. Let's look at Google. Okay. So Google, okay, Google you can see bulk of the time it's a trending stock. Let me hide the Parabolic SAR first. Okay, just using moving averages. Right here, the stock price has went all the way up. Oh, but it cuts the 50 days moving average quite a bit. It dances along the 50 days moving average, but it's always above the 200 days moving average, except here. So this is Alphabet or Google. So if let's say for a trending stock like this, let's add in the Parabolic SAR and let's see whether is it a lot clearer. Okay, great. So now the price has gone above 200 days. It is time to, let's say, take action using Parabolic SAR. Again, a lot of high side bias, I have to tell you this, but you can use it to see whether you like this indicator or not. Then let's say do it somewhere around here. Boom. Okay, I like this big candle up. Instead of, again, on high side, you thought that you have entered here, right? But unlikely. Probably will enter here. Goes all the way up and change in trend here. A very short change in trend. Just sideways. Boom, boom. Okay, maybe we'll exit here. So here, we will have, let's say, made, if you just purely use Parabolic SAR, probably 8-9% because this is perfect entry. I entered the, no, this is not perfect entry. I entered the top. If perfect entry is at the bottom, right? So it's pretty good. It's pretty good. Okay, so make about 10% in 23 days, in about 1 month. Okay, make 10%, 11%. Here, let's see. let's say, see parabolic SAR is here, and then we short. We short until here. Okay, guys, if you think we're going to short, it's a trick question. We should not short. Why? Because the bigger trend is uptrend. So I want to show you, just play with your mind a bit. We do not short a bigger uptrend stock, right? Because this is uptrend, we don't short it here. So likely, we are always going for bullish strategies like entry, buy low, sell high, buy low, sell high. So maybe we have entered here, and then we have exited here. Okay, we got whipsaw. Why am I showing you this? Because I want to tell you that the indicators are not perfect. It's never perfect, okay? So I enter here, I may have exited here. So within a few days, lost about 2 to 3% or maybe 5%. You can see, sometimes it doesn't work. But if let's say, okay, let me give me another chance. Enter here again, second day. And then move parabolic SAR, move all the way up, and I exit, let's say, here. Second day. Here. Okay, generally make about 4-5% in, let's say, 1 month. Well, if you can make about 4-5% a month, you'll be pretty good, okay? Even you make like 2-3% in a month, multiply by 12 months, that's like 30 over 40%. So you can see, okay, generally, it depends on how we move the chart. But generally, a uptrend stock, parabolic SAR works a lot better. Okay, so you can see this is another weapon that you can add to your arsenal of like analyzing your stocks. Cool. Now, I'm going to go into leading indicators as well. Is 250 MA more reliable than 200? It depends on the particular stock you are looking at. Okay, so let me give you one example. Hope you guys don't mind me going back to talk about moving averages again. So for moving averages, right? Example, let me show you this. This Meta. So these are some of the stocks I'm a bit more familiar with because I've been using them, investing in them. Okay, let me clear the parabolic SAR first. Okay, so for Meta, I realized that instead of using 200 days, oh, sorry, I have some entries into Meta as well. You see, Meta, instead of using 200 days moving average, I feel that about 180 is better. Okay, why do I say that? Let me show you this. Because Meta is always very far away from 200 days moving average. So I felt that, okay, I was actually looking back and adjusting it slightly. Settings. Okay, so you can see that the prices will bounce along this, acting as a strong support. So I rather use about 180 days. Because 200 days, again, too far away. By the time it's 444, it may already have turned into a downtrend. So depending on that particular stock's movement, you may want to adjust the moving average. How do you adjust to the point that it is suitable? You have to do a bit of testing. Okay, go and test 290 and see how many times the price touches and then bounce back up, touches and then bounce back up. It is a lot more effective. Okay, again, why? Because everyone else is using it. Everyone who is trading this stock is using it. Okay, so hope this is a great question. Hopefully this is answer your question as well. Okay, now let me go back to. Okay, thanks a lot, Chan, for asking. Feel free to ask more questions. I will aim to rock back and see some of the questions. Okay, now let's talk about leading indicators. Again, lagging indicators, okay, is for confirmation. It's for confirmation. So these are the, they will tell you what's the trend and things like that. Now let's go to leading indicators. For leading indicators, right, they are predictive. Okay, what do I mean by predictive? So let me use some examples. The very famous one is called Relative Strength Index. I want to always share the famous ones first because, again, a lot of people are using it. So they will identify overbought and oversold condition. Okay, what do they mean? So Relative Strength Index is a momentum indicator used to predict. Okay, and they predict this by saying that, okay, this particular asset is overbought. Overbought means too many people buy. When too many people buy, they are trying to say that it's too expensive. Please, okay, not say please sell, but please take note. Okay. And if let's say RSI, okay, is overbought when RSI is above 70 and it's oversold. Oversold means too many people sell already. Too many people sell means that the price is cheap when it's below 30. Now, how do we use this? Let me show you this. Okay. So for RSI, these are called oscillators and okay, there's a lot of terms to actually learn, okay, but don't worry, you'll become more and more aware of all this and all this will be useful. You'll add to your like analysis as well. So let's take a look at, let's say, Meta. Okay, since we are here at Meta, you can use the indicator here. You can type Relative Strength Index. Now, Relative Strength Index, for most of the platforms that you use, by default, they will use a 14 days Relative Strength Index. The specific calculation, you can read out about it, but let me show you how to use it, more important. You can see that, let me just enlarge this. You can see that by default, even like TradingView, they will highlight the 70 and the 30. So it's in a range from 0 to 100, okay? It's a 0 to 100. So let me show you this. Okay, you can see that sometimes this indicator shows that it's below 30. I hope it's big enough for you guys to see. Here is below 30. Let me just show you this. Yeah, let's fall into the below 30 range. Here as well, below 30 range. Now below 30, what it means is, or what traders use to analyze is, if it's below 30, it is considered, oops, here, it's considered oversold. Oversold. Okay. Okay, if it's oversold, means that the price is cheap, relatively cheap. Okay, here, below 30. So if it's cheap, should you buy here? Question is, should you buy here? Actually, answer is no. Reason is because it's a downtrend. Can you see you got a moving average downtrend? So you see, indicators shouldn't be used alone. It should be used in pairs. Okay, now here it is overbought. It's above 70. Can you see the 70 line? Let me check. I hope it's not too small. You all can watch back the recording. Okay, and zoom in. So the 70 line here is oversold. So oversold means, like, example, if you have bought it for some reason here, you may choose to want to sell it here. You can see after that it went sideways or even downtrend a little bit. Okay, so this is the overbought, oversold territory. Let me zoom in back in time and let's see whether there are examples. Okay, let's say we are bullish investors. Bullish investors means that we will want to buy. Okay, example here. This is possibly a good one. Okay, as I mentioned to you, you can see that for Meta, like 180, they will bounce 100. They break 180 here, but you see it bounce off 180. And if let's say I've studied and say Meta's 180 is very strong, and it was downtrend initially, the price is below 180 SMA. Now it breaks up, go sideways or almost turning into uptrend. Oh, but should I buy here? You look at RSI. Oh no, you shouldn't buy. It's not cheap. We want to buy when it's cheap, when it's here below 30. Can you see? So I wait for it to reach, let's say somewhere, to reach here on this fateful day. It's a very short spike down to below RSI 30 though. So just using as an example, in actual execution, it may not be so easy to catch. But here, if it's bouncing off against 180 SMA, the RSI is below 30, and we see that even the SMA 50 is still above SMA 200. So 50 moving average is above 200, still considered an uptrend. We may choose to enter here after this big red candle, okay, because it's hitting a support. Usually, if you enter here with the, I would say double, I don't really want to use this word confirmation, but these two indicators seems to indicate that it is a good time to buy. Okay, good time to buy because it hits a support and it's still uptrend. Good time to buy because it's oversold. It's considered cheap. You can buy here. So let's say you buy here. Again, when do we sell? Well, we sell if we sell here, it's gonna be flat, right? Okay, let's see. Let's see the actual what's gonna happen. We can sell here when it breaks SMA 200. No, SMA 180. Still a 15%, 200 over days. But it will be a better time to buy here than, let's say, to buy over here, correct? When RSI is not showing this. So RSI is a good way to actually show when to buy, okay? Or rather, it is a way that traders use to see when it's a good time to buy, okay? Or when it's a good time to sell. So conversely, if you are shorting the market, let's say the market is going down, it's downtrend, here is downtrend, below SMA 200, below the big SMA, the big moving average, which is 180, below the 50 moving average is crossover below. So this may be times you want to short, okay, but there's no confirmation from RSI. But if that RSI is above, let's say 70, is a good time to short. Okay, so this is the way that you use RSI. Combine indicators to use it. Okay, so far. So these are overbought, oversold indicators and RSI. And if you look at other indicators like even MACD, this is another one. Again, it's in my slides. Another one, slow stochastic. Okay, stochastic. Okay, all this actually shows overbought, oversold. So you can see they will move in pretty similar fashion because they calculate using price. But the calculation is definitely different. Otherwise, they will not have different indicators. But some of the traders like to use double confirmation. So stochastics is low. This is the oversold territory. Here is also overbought, so it's like a double confirmation that this place is really overbought. It may be a time for them to even reverse. So there are many ways to use it, but this is the most typical way. And usually the typical way is the best way to get started. I hope this has been like pretty clear so far. If it's okay, help me type okay. So I want to share with you all the last indicator, which I think is pretty cool. Okay, so should you use MA or SMA, right? Or EMA, correct? So EMA is a lot more sensitive because there's a weighted average. But the thing is this, what you need to do is you need to go and put in SMA, put in EMA, and then test based on the particular stock or forex or crypto that you're using, which one is more effective based on backtesting. Look at the past. If EMA is a lot more effective, use EMA. Oh, you got it? Okay, great. Now, actually, the last part I'm coming to, someone is asking, will you use Fibonacci? I love Fibonacci. Okay, so let me show you this. What is Fibonacci? Okay, I've met another Fibo fan. So another thing is called Fibonacci retracement levels. It predicts. So these are predicting. Okay, when we say predict means that, okay, it's overbought. I predict that it will actually go up. If it's oversold, I predict it will go down. So it's predictive. So Fibonacci is a crazy thing. Okay, it's called Fibonacci retracement or Fibonacci levels. So it tries to predict where the support and resistance are likely to occur. These are the common reversal levels. And let me show you how amazing it is. Okay, for me, I think it's very amazing. Okay. So for Fibonacci example, we can use Visa, we can use Coinbase, depends on which one we want. Okay, so what happened? Okay, let me show you this. Okay, so for Coinbase, let me delete all the indicators. Okay, let me give you an example here. Okay, so let's say example, we are looking at this particular movement. So we assume, right, this is what we are seeing. Okay, we are seeing like this. We are seeing something like this. So Fibonacci on the left side, let me confirm you guys can see this. Okay, so Fibonacci on the left side here, you can see this multiple line things. Over here is all the Fibonacci. There's retracement, there's Fibonacci trend-based extension. I pretty much like to use this. Okay, let's okay, but we use this one first, retracement. So retracement, there are many ways to use this. So you go to the top of the highest high, draw it to the low. Okay, this is one way to use it. Now you can see that these have different levels, correct? Okay, so when I say that it's predictive, let me show you. Okay, I have not tried this actually, but let's see whether it works. Okay, so imagine we are here right now. We don't know the future, but this particular line, you can drag it. So again, you can see the different levels. 0.786, 1, level 1.618. So make sure you see the levels. I'm taking from 0 to 1. Again, is this high to here. Now this dotted line will change, but you know that it is always at this level. Look at the black line. It will always be touching this particular high. So let me draw it all the way. Now after drawing it all the way, right, let me show you. Oops. See, it's still touching here. Oh, okay. I think I've drawn it a little bit too far, but no problem. Let's go back and see. Go back and see. It's still touching here, correct? Okay, a little bit. I have to adjust it a little bit lower. I mean, this is on high side again, but in the real life, Fibonacci works a little bit. I would say eerie. It's a bit eerie. Okay, why do I say that? Imagine you are only seeing this. You see that, okay, it has reached a bottom. It goes up to the top and it starts to drop. So when it starts to drop, right, when it drops, we know for sure that this is the top. So we draw Fibonacci from the top to the bottom, and then they will help us allocate and identify possible support and resistance line. Remember, again, it is here. We don't know what is going to happen. So imagine we have drawn the Fibonacci and draw it ahead. Let's see whether it can help us. Okay, again, I'm not sure whether it works all the time, but let's see. Okay, so you can see that there are certain support and resistance line that they will touch and then bounce back up. So there are certain golden ratios, like 0.1618, 0.382. So all these, right, every time they reach a particular portion, can you see that there seems to be some support and resistance, a natural kind. So they are reaching here, and remember, we were just looking at here only. We did not know that the price will drop. Okay, we will never know, correct? The price will drop to whichever level. Okay, but you can see that it drops to 0.382 around this area, and it starts to bounce back up. So all these support and resistance are identified as possible reversal area. So there are sometimes you will see maybe some people making predictions. Okay, they will say something like Coinbase is reaching here 185. If it managed to break out, it will possibly reach, let's say, the next level here at 253 here 253. They will predict that if they break, they will reach 253. Otherwise, they may drop back down to, let's say, 160. Can you see? It is pretty cool. So, okay, it is not like perfect touch and go, but it bounces around. It's like a magnetic force to the area. This portion didn't really, like, it's not totally magic, but you can see that they always bounce around here, and when it drops back around here. Here, as if there's another magnetic field. Is it obvious to you guys, or could you all see that? If you can see that, you can help me type FF of Fibonacci. So, by the way, this is a mathematical calculation. These are formulas created by, this guy called Fibonacci. So, is it by Leonardo? Okay, I think by Leonardo da Vinci, he actually came out with these few key mathematical levels. So, it is, to me, it's quite amazing. And you see, when they drop back down here, break back up. Okay, and right now, bouncing around, break back up again. Okay, so possibly the next point, it went back down. Okay, went back down to this level. If they're gonna break, they may reach this area again. Can you see? It's pretty cool. Okay, it's pretty cool. So again, may not work for every single stock, but it works as a benchmark. How does it work? Another possible theory is because everybody is using it, or many people are using it, that's why it works. They say, okay, it's hitting a Fibonacci level. It may turn, I better sell now. Then when they sell, self-fulfilling prophecy. Let's try another company to see whether it works. Nvidia? Some hot ones. Okay. Let's try Nvidia. Oh wow. So many. Okay, Nvidia. I'm not sure, man. Let's try here. Let's try here because it's bouncing up and down. Let's have some fun together. See whether it even works. This is Fibonacci retracement. Again, like I mentioned to you guys, many people has used it differently. Okay, later you can see there are other Fibonacci tools called Fibonacci extension, which I'll show you how to use it as well. So again, you see which one works well for you. Okay, so Nvidia, assuming we are back in time right here. Okay, back in time right here, we know that, oh, it has dropped down. So there's the highest point, the lowest point. Okay, it's not, again, I should have make it more specific, but you all get the idea. Okay, so let's see whether it hits at the point. Wow, it breaks out, straight away breaks so far. It may not work that well. Okay, breaks all the way, bounce back at this level. Wow, this one is way above, beyond what Fibonacci can even guess already. This one is parabolic, okay? So may not be the best idea for this. So this is but well, you can see that, wow, once it breaks up various levels. Okay, so another one here is called trend extension. So here you can see from here, go up all the way, draw back all the way down. So low point to the high point, to the low point again, and then that's where it's supposed to extend, and then help you guess various levels. So this is how Fibonacci is being used. Let's extend all the way. Am I doing correctly? Okay, extend all the way. Okay, and then let's do some prediction. So for Nvidia, certain support lines, can you see that? Certain support lines or resistance lines, oh, it's pretty amazing. Okay, so very likely Nvidia, but now it's a downtrend, right? Downtrend, if it goes down some more, it may hit the next level. Goes down some more, it may hit the next level. If it manage to change in trend, breakout, it may go back to 160. And if it goes even higher, go up to 210. So this is how Fibonacci is being used. Cool? How many of you find this cool? I'm personally quite mind blown when I first hear of Fibonacci. And encourage you guys to really go and Fibonacci. Do go and study it, because it's not just about trading, but it's about this mathematician. So there's a certain particular sequence, or mathematicians well, we already now know that mathematicians are pretty strong in investing as well. So these are maybe some patterns or anomalies or maybe certain mathematical models that we can actually take note of. Okay, cool. So these are some of the, again, what do we call that? Leading indicators. Because before it happens, we said that, oh, this may be a support line. This may be a resistance line. No 100% guarantee, but you can actually use all this as an example. No, you can. Now let me just wrap this out, and then I will pass you guys a slide. Go and have fun. So okay, I want to actually bring you guys back to this particular gentleman called Alexander Elder, Dr. Alexander Elder. He has this book called Trading for a Living. For those who actually wants to do trading for a living, this is the book that is a must read. So this book is very realistic, not much fluff. He tells you the truth about investing, talks about technical indicators, and he mentioned he has this rule of 5 bullets to a clip. So it means that in every single chart, there should not be more than 5 indicators. 5 is the max. You can use 2, you can use 1. Some of my very good friends who are very good in trading, like Julian, I don't think he even use any indicators. Probably just use support, resistance, and maybe just 1 more indicator for confirmation, and that's it. So do not use more than 5. So what it means is typically if you want to add a moving average, okay, add a RSI, add a Fibonacci, that should be it. That should be it. And remember your moving average, depending on how many you are using, it will clutter the whole entire chart. So make sure 5 should be the max. Can you all please type 5? So besides typing 5, a very quick and easy way to do position sizing is 2%. Again, where do I get this 2% from? Is from this book called Trade Your Way to Financial Freedom by Dr. 𝗵𝗃. So I've been reading all these books for years. I've been practicing them. 2%, it is not the perfect way of, I would say, position sizing, but do read up about it. The 2%, they call it the F ratio. So they have one whole entire book dedicated to explaining why 2% is the magic number. I'm more subscribed to 𝗂𝗏 criterion because it is more mathematically logical to me. 2% is a very safe method for you not to burst your account, because the key idea is you can lose a lot of times, but each time if you lose, you only lose 2%. You can last for many times. It's not 50 times. 2% times 50 is 100%, but each time you lose 2%, the next one will be 2% of your remaining capital. So you will never sort of lose every single thing if you just keep doing 2%. But there'll be a certain point in time that your capital is so small you cannot do anything. But again, it's very unlikely you can keep losing so many times in a row. You must be actually quite good, to lose so many times in a row. So this is what I have for you guys. I hope that this has been useful. You can come back and revisit the video, and you can get the slides. Go back to the Telegram group. So that's where all the slides will be. Now, I hope you have enjoyed the technical analysis portion. There are a lot of things that you can deep dive into, but the key things that I taught you right are the things that I've consolidated from many seasoned investors or seasoned traders using multiple time frames, using moving average. It's either trend or reversal, and these are the key things they use. Typically, nothing too complicated. What is complicated or difficult to apply is position sizing, because there will be a certain, I would say, temptation to want to get rich quick. If you use all this, you think that, wow, it's so good. All the technical indicators are telling me it's going to buy. You may still be wrong. In the end, you must still make sure you position size. Can you all please type PS for position size? So again, we can discuss a lot more next time. Next week onwards, I'll be talking about options. This one is my forte now. So once I start this, you all have to put a chain on me and pull me away from the computer, because I can talk about options non-stop. But excited to share with you guys really option basics. When I talk about basics, I will add in some strategies so that you can get started as well. So after we know how to evaluate stocks, get good stocks, we know when to buy, when to sell. Options are a way for us to enter with lesser risk, higher leverage, and also ways to make it like even market neutral. So excited to share with you guys next week. Hope that you guys will really stick around, learn together, build the wealth together so they can give together as well. So hope you guys enjoy yourself. I'll see you guys soon. Goodbye.